Have you ever wondered how banks make billions of money without selling a single physical product? No factories, no warehouse, no inventory. They don't manufacture products. They don't sell phones. They don't produce clothes. They don't ship boxes to customers. Yet banks are among the most profitable institutions in the world. So where does the money actually come from? In this video, we're going to explain clearly, simply, and factually how banks really earn money. And once you understand this, you'll never look at your bank the same way again. At their core, banks perform one essential role in the economy. They connect people who have money with people who need money. When individuals and businesses deposit money into a bank, that money does not just sit inside a vault. In fact, banks are allowed to lend out most of the money they receive in deposits. This system is known as fractional reserve banking. Banks are required to keep only a percentage of deposits as reserves, while the rest can be loaned out to borrowers. These borrowers might be home buyers, car buyers, small business owners, students, corporations. The bank acts as an intermediary, facilitating the flow of money throughout the economy. And this movement of money is where the profit begins. This system is safe, regulated, and closely monitored by central banks. Now, let's move on to the primary source. The largest source of income for most banks is interest. Here's a simple example. Imagine you deposit $10,000 into a savings account. The bank might pay you 1% annual interest. That means after 1 year, you earn $100. But the bank doesn't leave the $10,000 unused. It uses your $10,000 and lend that same money to someone else. Maybe someone taking a personal loan or equipment for business. And the bank might charge them 6% interest. If the borrower pays 6% annually, that equals $600 in interest. The bank pays you $100 and earns $600 from borrower. The difference, $500, is called the interest spread. That spread is a major source of bank profit. Multiply this process by millions of deposits and loans, and you begin to see how banks generate billions. The key to understanding bank profit is scale. A single loan may not generate much profit, but when banks issue thousands of mortgages, millions of credit cards, business loans, personal loans, auto loans, the accumulated interest becomes massive. Banks also adjust interest rates based on risk levels, economic conditions, central bank policies. When central banks raise or lower benchmark interest rates, it directly affects how much banks can earn. So interest isn't random, it's structured and regulated. Interest isn't the only income source. Banks also generate revenue through fees. These include account maintenance fees, a small regular fee the bank charges to keep your account open and active. Overdraft fees. A charge when you spend more money than you have in your account. ATM withdrawal fees, a fee for taking out cash, especially from another bank's ATM. Transfer fees, a charge for sending money from your account to another account. Late payment charges, a penalty fee for not paying your loan or credit card bill on time. And card replacement fees, a fee to replace a lost, damaged, or expired bank card. Individually, these fees may seem small, but across millions of customers, they create a steady and predictable revenue stream. Unlike interest income, which depends on lending, fee income is often consistent even during slower lending periods. Banks don't just lend money to individuals, they also invest. Common bank investments include government bonds. This means they lend money to the government and earn steady interest in return. Treasury securities, short or long-term loans banks give to the government that pay back with interest. Corporate bonds. Banks invest in corporate bonds too. That's when they lend money to companies and earn interest over time. And sometimes, banks even lend money to other banks through what's called the interbank lending market. These investments are usually low risk and regulated, and they help banks earn additional income beyond regular loans. Next is the currency exchange. Every time you exchange one currency for another, banks usually earn a small profit. For example, if you convert Philippine pesos into US dollars, the bank does not use just one price. There is a rate at which they buy dollars, and a slightly different rate at which they sell dollars. If you look at this board, you'll see two different prices for one US dollar. The buy rate is 58 pesos. The sell rate is 59.50 pesos. So what does that mean? If you bring US dollars to the bank, they will buy it from you at 58 pesos. But if you want to buy US dollars, banks will sell it to you at 59.50 pesos. That 1.50 pesos difference, that is called the spread. It may seem tiny, sometimes just a few centavos per dollar, but currency exchange happens millions of times every day. It applies when you send money abroad, pay for overseas online purchases, travel to another country, or even use your card internationally. Each transaction earns the bank a small margin. And when small margins are multiplied by massive volume, they become significant income. Now comes time. Time plays a powerful role in banking. Most deposits are short-term. You can withdraw your savings almost any time. But loans, especially mortgages, can last 10, 20, even 30 years. The difference in time is extremely important. Banks may only pay you a small amount of interest on your savings, but they can earn interest on long-term loans for decades. That means the same money keeps working year after year. In simple terms, time allows banks to extend earnings without increasing physical products or inventory. The longer money stays in circulation through loans, the more total interest income the bank can generate. Time quietly multiplies profit. Now, this doesn't mean banks operate without control. In reality, banking is one of the most regulated industries in the world. Central banks and financial authorities closely supervise them. Banks are required to maintain capital reserves, which means they must keep a portion of money available for safety. They must follow strict lending standards to reduce risky loans. They are required to manage risk exposure and undergo regular audits. These regulations exist to protect depositors, prevent financial crises, and maintain trust in the economy. Yes, banks aim to earn profit, but they must do so within strict legal frameworks. So how do banks make money without selling physical products? 1. They charge interest on loans. 2. They pay less interest on deposits. 3. They collect service fees. 4. They invest funds. 5. They earn currency exchange margins. And 6. They use time to expand total earnings. They don't sell goods. They sell financial access. So now you understand how banks make money simply. If you enjoy clear explanations of everyday things, subscribe to Everyday Wonder, because curiosity makes you smarter.